everyone. Thank you for coming back to Divorce at Altitude. I'm Amy Goscha, and I have the pleasure of having today Ashton Brooks with me today, who's a loan officer from Fairway Independent Mortgage. How are you doing today, Ashton?
Good. How are you?
Good. Can you give me a little bit about your background? How did you get into the mortgage industry?
So, I'm a generational real estate rat, I guess. My grandparents, so I have my dad's mom has been a realtor for, had been a realtor for 20 plus years.
Yeah.
Um, and then my other grandparents wound up doing real estate later on. My dad, because of my grandma's connections, she wound up having my dad become a loan officer. My dad moved up here to take care of my grandma because my grandfather was a welder and he traveled a
Oh,
lot,
cool.
and my dad was going to school to be a dentist.
Uh-huh.
Um, my dad dropped out of dentist school because my grandma was diagnosed with MS. So when he
Oh,
moved up here, he wound up hitting it off really well with her loan officer who owned a mortgage company.
oh,
Um,
really?
yeah, so he wound up being an LO. My mom was in processing for a long time. So then when I graduated high school, um, funny enough, in like middle school, I wanted to be a loan officer. So,
Wow. Yeah,
yep.
not many, that's pretty that's very specific.
hmm
That's pretty
Yeah,
cool.
people looked at me and kind of cocked their head when they're like, "What do you want to be?" I'm like, "A loan officer," and they're like, "What?" All right.
Not,
So,
not a firefighter, police officer. You're like, I'm a loan officer.
yep,
Oh,
yep,
that's great. Well, you're obviously in the right profession if you ended up there and you knew that so young.
yeah. Since I'm 29, I started at 17. So,
Yeah.
hmm
Yeah. So it's been a family, it sounds like kind of multi-generational thing in your family.
yeah, real estate to some degree or another. I followed my dad in the lending side. Enjoy
Yeah.
that. So, yeah.
Yeah. Well, that's great. Well, let's talk about the state of, I mean, it's very tied to the real estate market, but talk to me about the mortgage industry right now. Like, where are we at?
So, rates are starting to kind of creep back up slowly but surely, which we were honestly expecting. A lot of us were, just because with COVID coming in, lockdowns happening, rates plummeted, and we got down into well into the twos, as everyone is aware of, on a 30-year.
Yeah.
Since then they've been going back up, to three and a quarter, past that. Every day at this point, we just kind of watch what's happening day to day, kind of hoping for some reprieve. But it's been I would say like a constant slow bleed over the last probably 45 to 60 days, where we're starting to see it creep back up.
Mhm.
As far as purchases go, and what the market looks like on that side of things, doesn't seem to have slowed down very much. I mean, we're still busy. I guess I shouldn't say that. I mean, it's slowed down some, but that's also seasonal once you get into this time of year. I mean, once you get closer to like Thanksgiving, Christmas, everybody kind of goes into like a real estate hibernation mode unless you're relocating.
Yeah.
And so we expect things probably to, you know, depending on how much rates go up and how quickly, things should pick back up in the spring as usual.
Yeah. Well, talk to me about your process. I mean, I know that we're here to talk about mortgages and, if you have to refinance or if you have maintenance, how you qualify for a mortgage in the context of divorce. But tell me, what is your process and when do you get involved with, a potential client when they're about to, either refinance or get a new loan?
Um, I tell people honestly as soon as possible. So I've literally had people where they reached out to me and they're like, "Man, I need help with my credit, um, and I need a game plan. Like, I don't know what I'm doing." So, I mean, there's been clients where we've worked with them for literally over 3 years to get them into a house. Um, so I wouldn't say that there's ever a time that's like too early. If you have questions or you're trying to plan something, sometimes it takes 6 to 8 months to do it the way that you would ideally love to do something,
Yeah.
and sometimes longer. So we just tell people, man, if you have questions, just reach out. I am not big on like pressure sales or anything like that. I'm like, I'll give you the information, let you guys make the decision. Ultimately, as long as you're happy, we get to the finish line at some point. I'm good.
Yeah. And then
So,
if you lock in an interest rate, how long can you lock it in for, or does it depend?
so it's 36. Well, you can do 30. No, you can do 15 days in certain situations, which we have done a lot of save-a deals where like another lending institution screws up or something. So we do a 15-day lock, because the longer you lock your interest rate, the worse your pricing gets.
Oh, I see.
Your interest rates start to slip because you're guaranteeing yourself against the market for a longer period of time, right? It's not drastic, but you definitely pay to lock your interest rate for longer. So you can do a 15-day, you can do a 30-day, you can do a 45-day, a 60-day. Honestly, we have them at 185 days or 180 days and 365. So we can do long-term locks. Long-term locks are structured a little bit different. It's a lot for like, people right now, if they're doing a new build, and they're anticipating rates going up significantly over the next 12 months, something like that, we can look at doing like a 1-year rate lock. Those require like a deposit up front, and it's a little bit different of a process. And it's just like a 30 or a 60-day lock, because you're locking for a year. A little bit of pricing, like it's not like you get the same rate on a 30-day lock as you do a 1-year lock, right?
Mm-hmm.
So there's strategy that goes into it. We have to just sit down and just kind of look at every single one case by case.
Yeah, and before we get into kind of the specific divorce context, so Ashton, so I've been hearing about how everyone is like taxed to the max
Appraisals
now, right? Yeah. So we have like appraisers who, like you want to close on a house, you've qualified for your lending, but it's taking appraisers a lot longer to get things done. Is that affecting, I guess, your process at all? Right
Getting
now?
them done? No. I mean, we get appraisals back on average, I'd say 7 business days, 10
Oh,
business
wow.
days. I mean, yeah, we have, in certain circumstances, we can even do a rush. I mean, that's like non-rush turn times. Usually you can pay like a $250, $300 rush fee. If you get out into more like rural areas, that's where it does get tricky. Like when you get into your mountain towns, you get out way like in the southwest corners of the state, stuff like that. There's just not a lot of appraisers in those areas. So that's a different story. But around the metro and the whole like Front Range and all that, and even into certain parts of the mountains like Black Hawk and things like that, we're not having them drawn out or anything like that. The thing with appraisals that people have been battling are on the real, like for the longest time on the real estate side, on the resale side, just a home may be listed at say 500,000, but in order to get that home under contract, you're going in at 550.
Mm-hmm.
And you're saying that I'll cover the difference in the appraisal, whatever it doesn't appraise for.
Right.
And so we've been seeing a lot of competition with that for the longest time, and that's starting. There's a little reprieve there now, but turn times themselves, personally, we haven't seen any issues.
Oh, I think the issue that I was thinking of that I could see happening is because everyone is paying so much over asking price. Are you seeing that the appraisals are coming in and properties are getting appraised for, those over asking prices? And does that affect the lending at all, where people have to come up with cash at closing, like additional cash at closing? Have you seen that happen?
No, I mean, so let's talk about who that buyer is, okay? Because I think that's really important.
Yeah.
The people, the vast, and I mean vast majority of the people that are buying homes for a premium and willing to pay above appraisal are the people that just sold their house.
I see.
And so just because right now, a lot of first-time home buyers don't have $50,000-$60,000 to pay over the price of a home, and so they're just like, "Yeah, I'm out. No, I'm not doing that."
Yeah, they're not even in that game.
They're not even financially comfortable to do. Yeah, which I understand, right? So these people that are doing this and bidding on these homes are people that their homes are now under contract to sell and they're contingent, but they've also got 40 or 50,000 over for their house.
Got it.
And then they're getting to the point where they're past inspection. So they know what their money looks like when they sell their home, like how much they're getting and what that's going to look like. So at this point they're going, okay, I have most of them a 30 or 60-day lease back after closing. So I have another 70 days to figure out where I'm going to live. And like, I mean, we coach people on this and talk to them about this as they call me and they say, hey, we're looking for our forever home, which is a lot of this is, or either a step up home because you have another kid that you weren't expecting or something like that. We're dealing with a lot of that right now too. So these people are calling and saying, hey, my home is going to list it 525, and then they wind up going under contract at 570. They close at 565 essentially after some inspection stuff and whatever else. So they're like, all right, well, cool. I just got 50, 60 grand more than I was expecting for my house. So if I'm going to write an offer on a $700,000 home, here's 50 grand on top of the appraisal. And I mean, most of the time, surprisingly enough, a lot of the appraisals come in really close or at value.
Oh yeah. And that's still happening. It seems like even with these over ask or,
because the comps are able to justify it. It's pretty wild.
I know we haven't really seen a market like this in a while, or maybe
I don't think ever. Yeah. I mean, the inflation rates but what I talk about with everyone, and I actually did about a 25-30 minute video on my personal Facebook page. I don't have a business page. Everybody's my friend on Facebook, and I just keep people kind of up to date on my family and this kind of stuff every once in a while. So I had like a 25-30 minute video because I had a lot of people reaching out to me and being like, oh, I'm gonna wait to buy a house till the market corrects. And I'm like, okay. So I've been thinking about this for a long time, and there's a lot of real estate professionals that I talk to, and they're like, oh, they're stupid and they should buy now. And then there's other ones that are like, yeah, I don't blame them. And I'm kind of like, well, so I was talking to this gal that I do quite a bit of work with down in the Springs. And I was like, I'm going to do a video on this. Like, I'm going to run the numbers and see, like, if you buy a house now versus buy a house later, how does it change?
Yeah.
And so what I had thought about is how are home prices affected? So 70% of the market is driven by mortgaged homes, right? 70% of people that buy a house have a mortgage on it. So you have 70% of the market driven on what they're comfortable with as a monthly payment, what they're saying they can afford every month, right? So rates go down, 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 down. Money gets cheaper to borrow. Home prices go up, like practically at the same inverted curve, right? And it's because and I'm sure you can agree to this too, because you see people's finances all day long.
Yeah.
Especially like, with kind of the more like average person around Denver. Yeah. These people, your salaries haven't adjusted at the rate of cost of living here.
No.
And so you're at a point where you've peaked out what each salary bracket can afford in home price. Does that make sense? On a monthly payment perspective, okay, like within their budget. So at this point, it's like as rates start to go back up and really start to correct. And when I say really start to correct, like I've seen rates go from, I got in at 4 points when they went from 4.75 to 4.25, the whole country tried to refi. And then they went down to 3.25 and the whole country went ballistic again. And then they went all the way back up to like 5.5, and then all the way down to 2.5%. And it's just been this wild ride, right?
Right.
And the whole time home prices have been going up, but that's because the amount of living expense, there was room to do that within the Denver metro area. And now it's much more like your bigger scaled cities like Los Angeles and New York and your higher cost of living areas.
Right.
To where as rates are going back up, home prices, I think, are going to go back down in scale with like the monthly payment's not going to change for the dude that makes 90 grand a year. If he says he's cool with 2,400 a month, what 2,400 a month gets him now versus 2.5 years from now, if his pay doesn't change, is going to be the exact same. You see what I'm saying?
Yeah, I do.
So this video that I did was, you buy a house now at 299. You buy a house later at 5% 2 years from now. To keep your payment the same, it was like 2,500, 2,600 a month. The rate was 299, 5%. The purchase price was 500 and 400. So I was like, if you wait 2 years to buy that home for 100 grand less, and you have the same monthly payment, what's the cost of living. Like, what did you pay out in cost of living over like 10 years? Right. And it was like the same.
Yeah,
It was actually no different. It was crazy.
The same. That is crazy.
Yeah. And I was like, okay, so the guy, and the way that the numbers worked out is it was like the guy that owns the house at 299, he had a lower cost of living over the course of time because his rate was so low. The guy that waited 2 years was renting for 2 years.
Right.
So that's 100% interest. And then he moved in at 5% interest. So at the course of 10 years, they've paid out the same. The guy that bought the house at 299 still owes more on the house, but he's paid out less.
Mm-hmm.
The other guy has paid out way more, but he owes less.
Yeah, that's so interesting. And that's actually a good scenario because I have to look at that even when people are divorcing. It's like, do they want to rent? Do they want to buy? Can they qualify? And that's how I, got in touch with you, is I need people like you to talk to me about, can a person who has been a stay-at-home parent, how much money do they need, an alimony, spousal maintenance to be able to qualify for a mortgage. So we'll get into that. But kind of, moving to kind of the divorce context, what are some considerations that you see that people need to think about when they're getting divorced, related to mortgages?
Creditors, lenders, anything to do with finances, they don't care about your emotions and how you feel with your ex.
Right.
And what I mean by that is you have to, even in those, like in an emotional separation, you have to remember to just like be methodical, I guess, when it comes to just maintaining your finances. Because when you go to, I've had people literally reach out to me and be like, I'm leaving this person, I want to buy a home, then divorce them. And I'm like, do not do that. You're going to complicate things a whole lot more. Which I'm sure you can attest to.
Yeah, and when you say, just to clarify for like our listeners, when you say complicated, it's like a lot of times then you have to be on, you're titled together on another property, the loan isn't, titled jointly, and then you're still having to like refinance it. So it's not like you're untying that knot that you're wanting to untie.
Yeah. So definitely don't like buy a house and then file for divorce, because you're just going to create more work for Miss Amy over here. But anyways, the other one is we see people where, and I see this a lot too. One person either drains a bank account and doesn't pay bills, or they both get in an argument and they just don't pay bills. And when you get through the divorce process and one wants to keep the house and one's going to move out of the house and all this, and then you have to refinance that person off the house, you can't. Your credit's wrecked. No one's going to lend you money. And so then you have a judge on you, and then you're having to go back and ask for extensions and all this other stuff. And I've seen it multiple times. So just make sure that those bills are still being paid. Make sure that everything in your financial life doesn't get flipped completely upside down, because then you're going to stagnate yourself for literally, like, once you have that starting fresh and your separation is finalized and you're ready to start your life, you don't want to be boxed in from all these financial freedoms that you had just before. You want to be able to have access to credit and to be able to do those things that you're going to want to do, and not finance a car at 16%, 21%, stuff like that.
Yeah. And we definitely have people, obviously I deal with it all the time. You have clients that are going through divorce. But I think you're right. The biggest thing is to make sure to plan, you got to still be fiscally responsible. And it's super scary for people going through that because they don't know what they can afford. They don't know, and that's the first task that I do is I sit down with a client and I go through their budget. I go through their, their assets. And my guess is, at least my philosophy is that's a time to really bring someone like you in, looking at what are the options, if you have a client that's looking to purchase a house or refinance someone off of a loan.
Yeah. I mean, like I said, you can never get involved with like a true loan officer that knows what they're doing too soon. Because all they're going to do is just be like, you're not ready yet. I tell people all the time too, it's never a no, it's just not yet, right? Like, we got a couple more things we got to do. And with a divorce, it's very, very much like that. And that's why you and I, like with the person that we just had come up, not necessarily to segue too soon, but the person that we just had come through, you have to plan out before the separation is even finalized, how many months of alimony or child support you receive. In order for that to be considered usable income. And then on top of that, you also have to have so much time continuing to where you can use it as income. So if you have someone staying in a home that needs that additional support income to qualify, it takes a lot of planning.
And I mean, I think that scenario is a good one to bring up, because even as like a divorce attorney, like I'm not, like laws change or timing changes. And, I think that's a good example. I'm sitting in mediation. I'm thinking that as the attorney that, you need 6 months of alimony before you can apply, but then you just need, you need a term of 3 years. Whereas, when I talked to you, you were like, well, Amy, it's really going to take 4 years. So in the separation agreement, I really need to make sure that I'm putting in there that the duration of the spousal maintenance is for 4 years at a minimum. So, as a divorce attorney, that stuff changes, and I'm not like bootstraps on the ground in that industry. So, that's another reason why to bring, if you're looking at someone qualifying for a loan, to bring someone like you in, at the time, even before mediation, to run through all those scenarios.
Yeah. Because it does change depending on what type of financing you do as well. So if you do FHA financing, conventional financing, those differ as far as how much history. So everything with income on a loan is looked at in 2 parts, right? One is history and one is continuance. So we have to look at the history of what you've been receiving and make sure that, what we're using on the application is documented and verified. And then we also have to look at the continuance going forward, right? So like in particular with alimony, child support, it's just any type of maintenance. I've literally used, no joke, I have used puppy support as income on a loan application to qualify. A guy paid his ex-wife, I think it was like $250 a month for the dog. And he paid her travel and that kind of stuff. So we used it.
And that's one question I do have about the child support stuff is like, do you guys, when you're looking at, I know obviously you're looking at alimony, but are you looking at all sources of support? So including child support?
Yeah.
Okay.
Yeah, there has to be a history of it. And depending on what type of support it is, it's going to change to some degree.
Can you talk about that? And I don't know if you know all the specifics, but if you do, because I don't know about the different types of lending. Like, do you have any information on?
So FHA is, because when you had called me on the last one, I went up and talked with my SVP of underwriting. And let me double check this, but I'm almost positive I can just pull it up really fast. FHA was 3 months of history. So we needed 3 months payment history of it, and then 3 years continuance. Conventional financing, which is like FHA, is far more, 9 times out of 10, far more costly of a mortgage to borrow through versus a conventional loan.
And that's because you're also, what is the mortgage insurance called that you have on top of it?
It's private mortgage insurance. So FHA. So there's 2 types of mortgage insurance. One of them is what's called upfront mortgage insurance. And the other one is monthly. And that's what everybody's really familiar with. Like at some point that drops off my payment, blah, blah, blah. So FHA, they charge an upfront fee and they charge you monthly.
Oh, really?
And if you don't put 10% down, then the mortgage insurance never drops off. You have to refinance out of that loan to get rid of it. So Yeah, and even if you put 10% down, it's on there for 11 years. So it's
Oh,
on there
wow.
for a long time.
That's a lot.
Regardless of your equity position, they don't care.
Really. Mhm.
Where conventional financing, it drops off automatically at 78%. If your home appreciates, you do improvements. Like there's a lot of different ways you can get rid of that mortgage insurance sooner on conventional
Mhm.
financing. And if your credit is over like 680, it's kind of the tipping point. Your mortgage insurance is a lot cheaper on conventional financing.
Okay.
So, and you can choose one or the other, either the upfront or the monthly versus getting hit with both.
Okay.
So FHA, they're a little more lenient on a lot of things as far as qualifying goes. Like I said, when I talked with my SVP, he said 3 months for FHA
Okay.
as far as receiving alimony, receiving child support. And this is court mandated, right? So this is stuff that you guys finalize in a separation agreement or a decree or what have
Yeah,
you.
it could be. Actually, one question I do have is what happens if like, the divorce isn't final and we have like a temporary orders stipulation that's an order of court that says that, let's just say mom has to pay dad, child support and maintenance. Does that count, if it's court ordered, or does it have to be like the actual final, agreement?
It'd be a lot. See, and this is where this is my job. Like this, like what you and
Yeah,
I are talking about right now is like what I actually do all day. Because
I
at
know.
this point I go, okay, I need to sit down. I need to go with my SVP. We have to look at
Yeah.
the line by line in the gray area of it and make a decision on it. And that's where I confidently go, I feel good about being like, I can't guarantee anything, but I feel like I could make that work. Now,
Yeah.
what I would say, as just out of like doing this long enough, it would be a heck of a lot easier if that court ordered stipulation, that temporary one until everything's finalized, if the number didn't change.
I see.
Like if you get 3,000 a month in maintenance and then the finalized one is 4,500 and you jump that person up another 1,500 a month,
Yeah.
then underwriting is going to be like, we should probably see if this person's actually going to clear 4,500 a month to our borrower. So they may start you over. But if you go, hey, if I can go to them and say, hey, this isn't the finalized documents, but it was court ordered. And this says, because I'll pull it up really quick here.
Yeah, that's a good point though, Ashton. And those are all things, as I'm sitting in mediation, I'm trying to figure out and think about.
Yeah.
Because a lot of times we're being creative. I figure out like how much I think someone should be paying in alimony over the term. And then I'm looking at, well, should I make the term less or longer? Is this person to qualify? So,
yep. So this says, let's see here. Document that alimony or child support or separate maintenance will continue to be paid for at least 3 years after the date of the mortgage application, as verified by one of the following: a copy of the divorce decree or separation agreement. If the divorce is not final, that indicates payment of alimony and child support and states the amount of the award and the period of time over which it will be received.
okay.
If a borrower who is separated does not have a separation agreement that specifies alimony or child support payments, any proposed or voluntary payments may not be considered as income. That's conventional financing. FHA, they do allow for voluntary payments. So like if there's not an actual, so FHA, let me pull that one up here too. I do know that because I looked into that as well. I was like, what if there's no agreement in place and they've just been doing it? FHA, I'm going to pull it up just to be sure, but I'm like 99% that it's 12 months. So if they've been doing it voluntarily for 12 months and you can document it, and that's the tricky part, is we have to get a copy of the checks or something like that showing that it's made out to them each month, or a copy of, a lot of times now it's Venmo.
Right. It is Venmo a lot.
Yeah. So we do a lot of like just the Venmo between that person and just showing it boom, boom, boom every single month. But yeah, it's 12 months. I can tell you that for the voluntary stuff. It is 3 months for FHA if it's court ordered, and you still need 3 years continuance.
Yeah, that's good to know. Like, I mean, I didn't even think about that there would be a difference between FHA and conventional. So that's really good to go over. But another reason why to, work with you as a team member, when we're at someone specific.
And VA is going to probably be different as well. They don't even address it specifically.
Okay.
Which a lot of times they do that. they leave it up to the underwriter, which is actually pretty cool.
One question I do have for you is, so, like a person gets divorced, their decree is final. How long from when they start, like they put the application in, like how long does it take to get qualified, and how long is the process, I guess?
For me to take an application in, pull credit, and get a loan figured out, if it's a really complicated one, I'd say a couple days.
Oh, wow. That's really quick.
Yeah, I mean, I'm really spoiled and fortunate in the sense that a lot of mortgage companies, they don't want underwriting, like, even in the same building as production.
Why? I don't.
Just for conflict of interest
Oh,
reasons
I
and like
see.
influence. Like, you get a lot of underwriters, a lot of it has to do with personality traits of like good underwriters versus good salespeople, right? Your good underwriter wants to come in every day, shut the door, they're in their space, they have their music on, like they just do their thing and then they leave. And then they're very happy outside of work. And, you know, I love our underwriters. But a salesperson is very high drive, high gear, high emotion. They're very empath. You know, you're dealing with people's lives and the biggest financial transaction in their life a lot of the time,
Right.
right? So with that comes very tense situations between salespeople that don't know how to keep their composure and underwriting. And sometimes underwriting can kind of cave, and you know what I mean?
Yeah.
So my group has been together for 10 plus years. So, and some of us have been together for 15 plus years. Um, so we are like family. We go to each other's birthdays, that kind of stuff.
Yeah.
So I have underwriting on the floor above me and in our building, and they come down and talk to us every once in a while. We go up there. But we also, because of our relationship, if we have a disagreement, we can kind of tell each other that we're not liking you so much this week, and you
Yeah.
can kind of have it out, and it's all business, right?
Hmm.
Um, so so Fairway trusts us to do the right thing on both sides. Does that make sense?
Hmm.
So a lot of times I can go upstairs and my SVP of underwriting, he's not even a manager. I mean, this guy is like over an entire region of underwriters. He's on the floor above me. I just walk up there, sit down in his office. We have a great relationship. So a lot of times I just literally get Scott's word, and what Scott says goes.
I mean, that's great. I mean, you're really kind of explaining like a team approach. I mean, it's so important.
Yeah, it's well, yeah. I mean, like if we were to, when we came to Fairway, um, because our old company was bought out, and when the by a major home builder, the mortgage company that we worked for 15 years.
Hmm.
And it was the way that that company had been built was by friends and family, bringing friends and family in.
Hmm.
And so it was very much a team approach and personal, you know.
Yeah.
And so when they got bought out, we were just looking for that again, right? And Fairway's a very big company, but they have a really good culture. And the way that corporate operates is they want to get back to you very quickly, like speed to respond. They don't want to be in your way of doing your job. And they just kind of let us do our thing. So I still work with my dad. And so my dad left our old company, went to Fairway. Obviously, I went with him. And over the next couple months, several people followed my dad over. So we have I mean, at this point, um, and we lost a lot of really good people at the same time. But at this point, I mean, the people that did wind up coming over to Fairway, there's probably 30 of us, 35 of us that have been together for literally 15 years. So, and in the mortgage industry, it's very, very, very high turnover.
Is it?
Yeah, it's probably, I would say 3 to 5 years people last at a company. Um, we've been at our company now for going on 7 years, but the group itself, like I
Yeah.
said, I mean, it's 3 times the average of what you kind of see, you know, especially on like your production teams and stuff, like your loan officer assistants and that kind of stuff.
Yeah.
Um, they tend to bounce pretty quick. And a lot of ours have moved up into like processor positions and that kind of stuff. So
yeah, it's good to know that you guys have a good working relationship with underwriting, because I've had scenarios where like I'm in mediation, my client says that they talked to their lender and they've got pre-approval, and we finish the agreement and then it just falls apart in underwriting. So,
yeah,
it's just really nice
no,
that, as a listener, like you need to make sure that you're working with a mortgage company that is good, has been around for a while, like yours, has good relationships with underwriting. So that's really important.
yeah, we fortunately, we just have a good relationship with them. So I mean, if at any point I have any questions or concerns on a loan, I just go upstairs and I just sit down with Scott, or there's another gal that used to be on Scott's team that was his right hand person. Her name's Marta. She now oversees an entire other division. So between Scott or Marta, we just go upstairs, sit down, talk with them, and we don't leave unless we have it figured out. And if Scott's not cool with signing off on it, he's really good about. Scott's very approachable, and he's very much he looks at everything in an underwriting perspective of, if Fannie Mae or Freddie Mac were to send this back to us and say, we don't like this loan, buy it back. He's like, I have to have a way to defend what I did.
Right.
And as long as I have a defensible position, my win rate's like 80% with them, of being like, if not higher, of being like, no, this is a good loan and here's why. But if he's not comfortable making that call, then there's people that we can even go to past him in credit risk up to the CEO. And so there's even like 2 or 3 people above him, but it's not very common that we have to do that.
Yeah, I have another question. So if someone wants to refinance, so the divorce decree is final and they want to refinance and get their spouse off the loan of, like the marital residence.
Yep.
The same type of thing, like if the person that is wants to stay in the house is refinancing to get the other party off the loan, is it the same requirements for spousal maintenance to show, like with a conventional loan, 6 months of payments? Is it the same for the refinance?
Mm-hmm.
Is my question. Okay.
Yeah. Yep. They're going to need, on a conventional loan, after the court order has been put in place, you're going to need 6 months of payment history of that without missing any payments, right? Like they don't want to see that they missed a month and went late. So as long as there's 6 on-time monthly payments and 3 years continuance after, at the time of closing, it's going to go for more than 3 years, then you're okay.
Yeah. So, I mean, that's one of the biggest takeaways, I think, is that, if you're getting spousal maintenance, you really need at a minimum a duration of 4 years.
Yep. You have to. I completely agree. Because here's the other thing too. I mean, things happen, right? Like things happen. You get setbacks. People try to pay down credit cards and they don't have the ability to, or whatever the case might be. If you give someone, say, like 3 years and 6 months, like they have to close on a specific month. Yeah. And if that doesn't work for any reason, then you're hosed.
Well, I know, and that's not good planning,
So yeah, that 4 years gives me, not even so much me, but the client, in the event that something were to happen, it gives them like an extra 3 months to get it figured out.
Yeah.
So you're giving them like a nice window of time to actually get this done, instead of trying to make sure that it fits into one calendar month.
Yeah. Okay. That makes sense. And then I guess the other question I have is for divorce attorneys, because we have, clients, we also have other like divorce attorneys and lawyers that listen to our podcast. What would be your, I guess, recommendation to a divorce attorney, as far as like what information you need, or how can we help make the process easier when you meet with like one of our clients?
If you guys have gone through any sort of a budget or put together a budget with them, just let me know.
Okay.
Because one of the things that we talk about with our clients all the time is, listen, there's a difference between, trust me, there is a difference between what you qualify for and what you can actually afford. And a lot of times you qualify for much more than you can afford. Right. Because depending on the type of financing that we're doing, they take or don't take into account certain things, right? Like we don't look at your cell phone and cable bills, and we don't look at how much you pay for your kids' soccer and baseball, that's a travel league. Like we don't look at that kind of stuff. but you guys know that you got to budget $1,000 or $1,500 a month for baseball and volleyball trips or
Yeah.
camps, or you know what I mean. So a lot of times I'll call people and be like, hey man, if you want, you could have a $3,500 a month mortgage. And they're almost like, because they're like, well, what's the max? Like, how much can I go to? And I tell them, and they're almost like put off by it. And I'm like, well, that's why we talked about, like, there's what you want to actually pay
Right.
and what you can get yourself into.
Right.
So
yeah, so, and that's one thing that I've really started focusing on is when you're going through a divorce, like where you think you're going to be at financially in a year, when you're going through that, you just can't really see that. So you really need to crunch the numbers. Like going back to your point of, not that, divorce is emotional. You can't just take the emotion out of it, but you really
correct.
can't let everything else, like your financial position, go to the wayside.
Yeah.
So that's where people like me and you can come in and kind of really look at the situation and can run the scenarios and help them see,
Yeah, absolutely. And if you feel like you're the type of person that you're just going to get overwhelmed, then bring professionals in sooner than later.
yeah,
Because then we can at least be like, hey, these are the things you need to do. And like to kind of help, I wouldn't say stay on top of you and babysit you, but at the same time, like keep you on track and just remind you of the things that you may just forget about otherwise.
yeah. Well, that's
Because it
great.
happens.
Yeah, it does. I know. And we've all seen those scenarios. So
Mm-hmm.
we can help people learn from those and avoid those. Well, Ashton, anything else, as we wrap up that you think would be important, I guess, from a client perspective or an attorney perspective, related to mortgages?
Outside of just, which pretty much goes for everything, but communication is key. I try to be extremely thorough and detailed. The more details that someone can give me about their personal situation and what they're walking into with a separation, it helps me do my job a lot easier.
Yeah.
So, and it'll take a lot off of you as an attorney or you as a client.
Yeah.
If I'm brought into the scope of what's going on.
Yeah. And you have all those details.
Yep.
Well, great. Well, Ashton, thank you so much for coming on as an expert today. I really appreciate it. For all of our and for all of our listeners, can you just tell listeners how they can get in touch with you via email or phone?
Yeah. So I don't have a desk line, literally. I haven't had a desk phone for probably 5 years now. It's just my cell phone. So my cell is 303-731-9155, or my website. You can go on there, fill out information for me to contact you, fill out an application, or it's got my email and all that stuff. And that's just my last name, Brooks, Brooks, lending.com.
Great. Well, thank you, Ashton. I appreciate it.
Absolutely. Thank you.
Okay.